So she was selling her property. Now this lady bought the property for $700,000 like 25 years earlier. Okay, she had a live-in boyfriend. Never put him on title. So when she was selling the property, she discovered that only herself had a capital gains exemption of $250,000. Her live-in boyfriend was not on title. Therefore, they could not extend $250,000 exemption for him. If you're a married couple, you get $250,000 per person, okay, that's on title and living in the property. In order to claim that, you have to have 2 years residency in the last 5 years. Okay. Now they're going to sell this property. The expenses were 6% for realtor fees. Total selling expenses, including realtor as well as title fees, was $192,900. So the net from that would be $3,222,100. I said it was $700,000. I made a mistake. It was $550,000. She bought the property. Over the years, she put about $400,000 improvements in that property, so she's able to write that off.
How did you confirm?
I'm sure she'd have some records and documentation to support that. You know, I mean, if you got challenged by the IRS, you definitely want to have your ducks lined up. You know, everything documented to show that.
Okay. Receipts.
So net adjusted basis is $950,000. The taxable gain based off that is $2,072,100. The homeowner's exclusion of $250,000 is there, so that reduces it. So the total gain subject to capital gains tax is $1,822,100. Okay. Now capital gains on the federal level is 20%. So 20% of $1,822,100 comes out to $364,420. Now the state of California also has their version of the tax, capital gains tax, and it's 13.3%. Again, using the $1,822,100 at 13.3 equals $339.30. So that's what's due. Also, there's what we call Obamacare tax of 3.8%. The rich selling, they take from the rich to help the poor. 3.8%, so another $61,639.80. Now, the projected federal and state, as well as Obama tax due, is federal, state, Obama tax comes out to $668,399.
Wow.
Okay, so you can understand why a person in her position would like to move on with her life, but writing a check for that much is a pretty scary thing for a lot of people.
Yes.
Now this is the proceeds without tax planning. This is if you did not have a monetized installment sale. Okay, you had your assumed sales price, the net available for debt payoff, then the mortgage payoff. The net before tax profit is $1,381,100. Then you had the federal, state, and Obamacare for $668,399. So the net proceeds after selling your property for this, paying off the debt, and paying the federal and state and the Obamacare taxes is $712,700. Okay? So the tax hit is about collectively is 32%. Okay.
Yes, a lot.
Now, if we do a plan such as a monetized installment sale and plan it, this is what it would look like. You have your sales price at $3.215. The net available loan before debt payoff is $3,022,000. You have to pay off the mortgage at $1.641. Net cash before taxes is $1,381,100. We're going to defer the taxes and the federal and state taxes. So the monetized installment loan at 95%, less 1% for the loan origination and half a point to pay for escrow accounts. These are the expenses to set up the monetized sale. So in the car, you may remember that I said that the seller would get 93.5%. Okay, so here's 95 minus a point and a half for loan fees. Okay, so they net 93.5%. So right here, you're deferring your taxes. So she's going to net 1.291,328.5. So that's the cash. It's not tax-free, and I don't want to say tax-free, but it is tax-free in the net to her, and you're deferring the taxes. Okay, so the grand total, net after tax profit at close of escrow, 712. Cash tax-free available at close of escrow. So an additional $578,000 is going to the seller that would have normally have gone to the IRS. Okay. So now the projected state and federal and Obamacare taxes was $668,399. If you take 25% of that and get an interest, compounding interest investment vehicle such as an annuity or insurance, or that compounds per year, compounds per year, 30 years. The projected future value in 30 years is $722,195. This is why I was setting up that appointment with Tina, who is one of my teammates, and with Victor, who can do this. He's done this twice already. He's closed 2 of them already. And he used, through his insurance services, was able to create they quote 5%, but they're used to seeing 8 to 9%, 10% on the return. And they go back using previous years, the yields for previous years, and it averages out way over 5%. Okay. Okay. So if this was an investment property, you could plug in the calculator for that. If say this person was, instead of an owner-occupied sell, it was an investor sell, then we would have to do the calculations for depreciation and the recapture of depreciation. Okay. So with that, that's an overview of a transaction that happened about 3.5 months ago. Linda McKnight was the introducer, and this lady who Linda was able to save an additional $578,627. She is just singing Linda's praises because it freed her up and enhanced her retirement. Okay, so that's an overview of that. Now let's go over one other thing, and let me find it real quick. And it's a PowerPoint. See if you can spot a PowerPoint. I normally, on my laptop, every time I start it up on the system, it puts everything back. I try to put things where I can just grab it in sections. But
you can search in your computer.
Oh, if I open this up, it'll blank out the screen, unfortunately.
No, search on your computer. Windows search, you can find.
Okay.
Search programs and files.
Okay. Okay, thank you. Okay, PowerPoint. Okay, thank you. It's good to have that new generation helping out the old guys. All right. Like in the car, I was mentioning there are 3 parties in a traditional sale. Okay, so you've got the buyer and seller, and you have the escrow company, which is neutral ground between the 2 parties. Okay. So in a traditional sale, you're familiar with this. The seller sells directly to the buyer. At close of escrow, the title company distributes money and instruments of transfer.
Mm-hmm.
So the buyer gives money, and they receive, documents showing that they are the owners, the new owners of the home. The seller receives the money in exchange for the asset. Okay, pretty straightforward. When a seller receives their sale proceeds, it's called constructive receipt. Okay, and in a tax scenario like this Los Altos home, if she had gone that route, she would have owed us $668,000 in capital gains. So if she had $1, it would trigger a constructive receipt scenario, and then she would have to pay it. That's why there's another way to do this. Okay, constructive receipt, the tax is due now. Often sellers can face as much as 30 to 40% or more of their profit going to taxes. Once the tax bill is paid, those funds are gone forever. There is a way to sell assets, postpone constructive receipt, thus postpone the tax bill, yet still receive the cash at close nearly equal to the selling price. That's that 93.5% that I mentioned to you. Okay. Introducing monetized installment sale. Here are the parties. Instead of just the normal 3-party,
now it's 5.
now it's 5. And we'll go over the role of each of these players. Okay, so there's a capital asset dealer and a private lender. At close, in a monetized installment sale, rather than selling directly to the buyer, the seller sells the asset to the dealer, the capital asset dealer. And that's the insulator from constructive receipt. Okay, it keeps constructive receipt from ever happening. And the seller sells the asset to the dealer on a 30-year installment sale contract. Remember, we talked about incremental sections of the sale, not selling all at once and having the capital gains triggered. What they're doing is they're breaking it up into 360 payments over 30 years. Okay. All right, so the seller sells to the capital asset dealer. The terms of the installment sale contract between the dealer and the seller are no money down, interest only, non-amortizing. You pay 30 years, and it's 100% net sale proceeds. Okay. The terms of the contract delay the constructive receipt for 30 years. Okay.
And taxes are deferred as well.
And taxes?
Taxes
And,
to IRS are deferred.
yeah, they're deferred to the IRS. Exactly. The contract terms provide that not $1 of sale proceeds are paid to the seller for the first 30 years. The result, no constructive receipt for 30 years. Next, in a simultaneous close, the dealer resells the asset to the buyer. And you got to remember that the seller sold the property to the asset dealer first. Now the dealer has control of the property, right? And then the dealer turns around and resells the asset to the buyer and tries to make it seamless. Okay. The buyer, see, this is all on the same day. It's all simultaneous. Okay. On the same day, for the same agreed price and terms, with the same warranties, by the same instrument of transfer. Okay. The buyer's transaction is completely unaffected by the monetized installment sale. Okay. At this point in the transaction, the buyer's funds were received in escrow, but the seller, our seller, doesn't receive those funds. The asset dealer, receives those. The capital asset dealer receives those funds, but the seller doesn't. The seller has relinquished the asset. The sale proceeds are moved to a third party. There are no seller liens against the asset. And the buyer receives asset with clear title, and the buyer, I should say the buyer receives assets with clear title. The buyer's side of the transaction is complete. They get the property and they have the documentation. Next, the seller receives a tax-free monetization loan nearly equal to the selling price. Okay. The terms of the loan are no money down, interest only, non-amortizing, 30 years, and